Hey VFam, it's Terry coming to you from Invest Roundup. It is a Christmas full of lawsuits, crackdowns and maybe some jealousy. Google and Alibaba are not having a good time, I'll tell you that. But that being said, with all the bad news, there are also good news. For example, one of our favorite streaming platforms is getting spun off into an independent company. Also, behind every lockdown, there's a business that's thriving. Most of us are just too busy to notice. Which industry and company is this? Let's get into this week's news. Disclaimer: whatever stock or news we talk about is not a recommendation to buy or to sell. These are all just news we deem important, things we think we need to know about if you're invested in the stock market or if you intend to invest. First news item, we talk about the trouble with Google. Google was hit with an antitrust lawsuit by the Department of Justice in the US, apparently for unlawfully maintaining a monopoly in online general search and depriving rivals of key distribution channels. The state of California later sought to join this lawsuit against Google, according to a court filing last Friday. This move was later followed up with not one, not two, but 11 other states in the US who filed separate antitrust complaints against Google, which targets its advertising technology services. According to the complaint, Google unlawfully acquired and monopolized the online ad market. It also alleged Google has engaged in unlawful tying arrangements, so publishers had to use another Google tool if they chose to operate on its ad exchange. It also claimed Google to be exerting leverage and extracting payments from all steps of the online ad process when it acquired ad tech company DoubleClick in 2008. The complaint also claimed Google and Facebook to be co-conspirators and harmed competition through unlawful agreements. A Google spokesperson, however, told CNBC that the claim of an unlawful agreement with Facebook is not accurate and that the Attorney General's claims are meritless. A third antitrust lawsuit is expected to be filed against Google from another coalition. That suit is also expected to target Google's search services, but focus on how its changing design has disadvantaged competitors. Google had since denied the antitrust and maintained that people use its services because they choose to, not because they lack alternative ways to search for information on the internet. Of course, this lawsuit is not the first of its kind. This is just one of the growing legal pushback against tech giants. But here's the plot twist. What most of us don't know is that the lesser-known Oracle Corp had spent years working behind the scenes to convince regulators and law enforcement agencies to rein in Google's mammoth-sized business. And from the looks of it, those efforts are paying off right now. Oracle may have fallen behind the tech giants in the marketplace, but they are certainly winning one legal battle after another against them, especially Google. And admittedly, Google's share price has been affected since the beginning of the month. Now, that's how you take down your competition. Second news item, cracking down on Alibaba. Alibaba took yet another hit from China's regulatory crackdown. Now, if you haven't heard, a few months ago, China's regulators announced a new ruling to crack down on major Chinese tech companies, which means in the line of fire is none other than Alibaba. On Christmas Eve, even though Asia-Pacific stocks were mostly higher, Alibaba shares dropped by 8.13% on the Hong Kong listing. I mean, what a Christmas present, am I right? Alibaba's US listed share also got hammered by the news, falling 13.3% to $222 on the same day. That's the biggest daily percentage decline since the company's IPO in 2014. China's State Administration for Market Regulation said last Thursday that it has opened an investigation into Alibaba over suspected monopolistic behavior. Supposedly, Alibaba pressured merchants who sell on its e-commerce platform into forced exclusivity arrangements, which prevents them from working through rivals like JD.com, which means these merchants are given the option of either listing their products solely on Alibaba's platform or not at all. An analyst, however, was quoted telling Barron's that e-commerce sales industry-wide are growing at a 20% rate in China and Alibaba's practices don't seem to be hurting competitors. Alibaba had since confirmed the investigation, and not only that, Chinese authorities also said they would meet with, surprise surprise, Alibaba affiliate Ant Group to discuss and supervise them on operation issues such as matters concerning consumers' rights and interests. Just last month, regulators abruptly suspended the company's massive initial public offering just days before the planned listing in Hong Kong and Shanghai. Ant Group was then forced to withdraw the $34 billion IPO. Now, to some, this is a nail-biting affair. But to some experts, this comes across as a no-brainer. Some major funds are already selling off Tesla and Apple to buy even more Alibaba stocks, while another source was quoted to say the regulatory impact on Alibaba's operations are immaterial and that investors should buy more now. And they have a point. At the moment, Alibaba's fundamentals still looks rock solid and they're considered to be a medium-risk investment. By the way, before we go on to the next news item, click on the subscribe button below now so you will be informed the next time we upload a new episode. That way, you won't miss any important market news. Third news item, Vimeo is going independent. YouTube's previous direct competitor Vimeo is spinning off into an independent company. Its parent company, IAC, recently announced that they are planning to turn the video streaming platform into a publicly traded company soon. According to the company's spokesperson, the spin-off came about due to the boom in software-as-a-service stocks, thanks to the COVID-19 pandemic. In Vimeo's case, it has reported strong user growth in the past year, with subscribers up 24% in just November 2020 alone. Its most recent quarter was with positive EBITDA plus year-over-year revenue growth of 44%. And in fact, for the first 9 months of 2020, Vimeo's revenue was up $199.4 million, which is a 41% increase from the comparable year earlier period. Even though they were previously in direct competition with YouTube, which focuses on streaming entertainment, the company had re-strategized a few years ago to provide video services for businesses instead. Great move, by the way, if you ask me, because come on, competing with YouTube? Really? Today, the company said it had 1.5 million paying subscribers and 3,500 enterprise clients, including Amazon, Starbucks, and Deloitte. If this deal goes through, Vimeo will become an independently publicly traded company around the second quarter of 2021, after shareholders' approval. Even currently, the company had already achieved a $2.75 billion valuation after raising $150 million in equity from a few different sources. Vimeo's parent company IAC saw their shares jump 16.6% last Tuesday morning after the company announced this spin-off. Although, we did notice that the share price is above its intrinsic value. So, you might want to tread carefully. If this comes true, it will make Vimeo the 11th public company to spin off from IAC, the previous one being the online dating company Match Group. And finally, we look at a stock that is probably the first of its kind to make headlines this year, and they are making billions just from exercise. The stock market may have been abuzz recently about Tesla joining the S&P 500, but did you know that another company, one that has been quietly thriving in the worldwide lockdown, has recently joined NASDAQ 100? If you have not heard about them yet, they are a home fitness firm called Peloton. The stock jumped 16% last week after joining the NASDAQ 100, and this is after increasing by as much as 392% this year. Not surprising though, because with COVID-19 pandemic shutting down gyms all around the world, the way people worked out and exercised has significantly changed, which drove up the demand for in-home fitness solutions. In fact, during this period, Peloton couldn't ship its bike fast enough to meet the demand surge. They also introduced new equipment at varying price points and lowered the price of its flagship bike. And guess what? It doesn't stop there. The companies also announced last week that they struck a deal to acquire an exercise equipment manufacturer called Precor for $420 million in cold hard cash to widen their empire. Precor makes cardio and weight machines and is among the largest commercial suppliers of fitness equipment in the world to hotels, universities, fire departments, and health clubs. So, Peloton's plans for Precor here is to use their 625,000 square feet of manufacturing capacity to make more equipment and ship it to the domestic customers sooner and cut down the waiting time. It is worth noting that this is not Peloton's first acquisition. Before acquiring Precor to be one of its division, Peloton also acquired one of its bike manufacturers, Tonic Fitness Technology, in Taiwan, and a digital music aggregator, Neurotic Media. Now, if you think Peloton is going to cruise on this momentary victory, you're wrong. Peloton is aware that they could be thriving just for now because there is a lack of competition in the space. The founder was even quoted saying one of the reasons why Peloton is doing well is just that there hasn't been that much innovation or capital or software or even content for that matter going into the fitness category. So, we will keep our ear to the ground. And as if answering to this call for competition, Apple, yes, the iPhone maker Apple, recently came up with Fitness Plus. This service, going for $9.99, allows iPhone, iPad, and Apple TV users to access exercise classes, and unlike Peloton, you don't need a specific equipment for each workout on the list. Better watch out there, Peloton. All in all, Peloton stock has skyrocketed 450% this year as more people invest in home gyms and online fitness classes. So those are the 4 important investment news we had to share with you this week. Once again, we encourage you to get more information if you'd like to act on any of the companies we've shared about earlier. Comment below and tell us what you'd like to see on Invest Roundup, and share this video with your friends, especially those who are vested in the stock market. See you next week!